Hit it. Let's start in. Hello, everyone. Welcome to the Spartan Storage, the Diversified Growth Fund, which we're very, very excited to present. This is our last offering of 2023. So thank you so much for everyone for joining us. I can see a lot of people funneling in here. So we're going to give a few more moments for everyone to sign on before we get going. Agenda for this evening, about a half-hour presentation on this newest Diversified Storage Growth Fund, and then Ryan Gibson of Spartan Investment Group will be joining us for some Q&A. So with that,
let's kick it off.
About 5:30 and 5:30. Yeah, let's kick it off. Thanks everyone for joining us. We appreciate you being here. My name is Tate Duryea. I'm the founder and CEO of Turbine Capital, and I'm joined by Suja Sham of Lux Capital Investment Group. And if you've been an investor with us for more than a few years, then you might recognize that name because Suja and I have been fund managers on multiple deals together in the past. We actually launched our two businesses concurrently, and so we're both participating on the fund that is in question here, and so we're combining forces for this webinar tonight. This is the fifth collaboration with Spartan Investment Group that both Suja and I have done. That's in addition to my personal investments with Spartan. And of course, if you are an investor with Turbine Capital and you're familiar with our podcast, Ryan Gibson, who's the CIO of Spartan Investment Group, is the co-host of the Passive Income Pilots podcast. So you certainly have seen that name before. So Suja, let me kick it over to you to introduce yourself, and then we can kick things off.
Okay, sounds good. Hey everyone, my name is Suja Sham with Lux Capital Investment Group, and I've also partnered, as Tate mentioned, on several other deals with Spartan Investment Group. We're really excited about this growth fund. It's an amazing opportunistic deal with a ton of potential for growth. We've really seen Spartan's strengths in the development and construction space leading up to stabilization of assets. And so this is really just aligned with their strengths perfectly. We've seen some really successful exits, so we're really excited about that. With Lux Capital, I also host a podcast, Passive Income Unlocked, and we also invest in other asset classes. This is the first storage deal that we're investing in a couple of years, so it's really exciting. And with that, let's get to the rest of the presentation.
Thanks, Suja. Yeah, it's been 2 years since our last storage opportunity, so really excited to have another one on the docket. Some quick disclaimers to get out of the way. We do not offer tax or legal advice. Do your own due diligence, consult your own team. And this is just a general overview. A full legal document and PPM, private placement memorandum, is available on the deal room, and subscription funding will take place on the deal room as well. I've already introduced myself. Suja, you've introduced yours. So skipping straight to the Spartan leadership team. Ryan Gibson is the CIO and Scott Lewis, the Chief Executive Officer of Spartan. This is a vertically integrated company with 150 employees. Really had a chance to grow with Spartan over the past half decade, and always been very impressed with their acumen and their grit. They've got 30,000 units in their portfolio, 150 full-time employees. They've raised over $250,000 from private investors, approaching $750 million of assets under management. And it's a veteran-owned company. They've been on the Inc. 500, for the last 4 years in a row. So that's a little bit about the Spartan sponsorship team there. Their track record specifically is listed here. This excludes all those deals which are still under management, many of which we are in with them. And again, always been very impressed with their professionalism and the level of institutional talent that they've brought on board over the last few years, particularly in order to manage some of the more challenging projects in their portfolio. So it hasn't just all been blue skies and tailwinds for Spartan. It's continually been a challenge here and there with certain projects, and because of that, they've brought on some incredible institutional quality leadership in the VP ranks, which really adds to their the level of operational expertise that's on their team.
Yeah, and just to add on to that, Tate, so just to clarify, there was a question in the chat, you already said it, but this is only showing their exits. So there's a lot of other portfolio properties that they manage that are not reflected on this chart, but this is to show how they've done when they've exited. And another deal that they've actually exited from, or at least a property, Tate and I are both in this deal, along with many of our investors, recently just exited, and it was very successful. Just to briefly review it, we bought the whole portfolio for around $9 million in 2020, and they just sold one property, one of the 5 properties in that portfolio, for $8.5 million. So not only have we been issuing distributions this whole time, we just were able to return 100% of investor capital plus more. And there's still 4 properties left in the portfolio, which we will continue issuing cash flow distributions for, and eventually there'll be some exits of those 4 properties as well. So while past performance isn't an indicator of future performance, it's important to look at the track record of anyone you're going to invest with.
Thanks, Suja.
Moving on.
So this is just a quick look at Free Up Storage. This is Spartan's national storage brand. If you've invested in any of the Spartan projects in the past, you'll notice the Free Up brand is on everything that they do. Of those nearly $750 million of assets, they are all under this umbrella of Free Up Storage, which is their, Spartan is the equity company, the investment company. Free Up Storage is the actual storage brand. It's all in-house, so it is a vertically integrated company with vertically integrated property management. Big focus on automation. One of the great things about storage is the fact that the operational expense of leasing managers and things like that is very, very low. There's also a ton of opportunity to implement automated solutions for entry and exit and that sort of thing. And then they also have a great network of on-the-ground regional managers and asset managers who are very attentive to the portfolio. And with that, Suja, I'll pass it back over to you to talk about the Spartan Construction Management.
Okay, great. So particularly, as Tate mentioned, Spartan is vertically integrated with regards to their property management team, and they're also vertically integrated with regards to construction. So Spartan Construction Management is the construction arm of Spartan, and they have a really pretty remarkable track record already. So combined 100+ years of real estate and construction experience within the construction management team. In addition, they are currently have already constructed 500,000 square feet of self-storage development across 14 development projects. So really a tremendous track record at this point, and they are all dedicated to making sure that every asset in the growth fund is a success.
I'll add in there that Aaron Saunders is the lead on Spartan Construction Management. We had a podcast with Aaron Saunders. If you want to take a real deep dive on the Spartan Construction Management side and everything that goes into building a self-storage facility, you can check that out by just searching Passive Income Pilots and Aaron Saunders. Excuse me.
Awesome. All right. So where is it that the Spartan team invests? So you'll see that primarily we're in the Southeast, and a lot of that is because of the demographics in that area. Texas, Georgia, Tennessee, etc. There's strong job growth in those areas, strong rent growth. There's overall positive migration to those states and those areas. We always look at that whenever we're looking at self-storage, because self-storage is largely dependent on population. 1 in 10 Americans have a self-storage unit. And so whenever you have those positive demographics, it's a really positive sign for investing in self-storage. We also want to make sure there's income growth, and we like to invest in properties that are relatively close to each other, because then we get economies of scale. So that's why you'll see these clusters. And again, why self-storage? So self-storage is a relatively non-consolidated industry compared to multifamily. And what that means is there's more institutional capital that has purchased multifamily, whereas self-storage still has quite a bit of number of mom and pop owners. And what that means is that when you purchase a self-storage property and turn it into a optimized operation, then it becomes very valuable. And there's more and more attention that's coming to this space from private equity groups. And here's just a little bit more about storage. So storage it's one of the best performing asset classes, if not the best commercial real estate asset class that has over the last 40 years. And again, 1 in 10 Americans rent self-storage unit, but it's not just individuals, also businesses use self-storage as a way to expand or contract in an affordable way because it's much less expensive to rent storage space than it is to rent retail space. As Tate mentioned, there's a lot of automation. So we have very few human dependencies compared to a multifamily deal, which is much more human resource intensive in terms of maintaining the property. And we also have relatively low maintenance. You know, we don't have toilets, we don't have showers. It's relatively easy to maintain storage. It's also easy to evict, which is not the case with multifamily. That can be a very complicated and drawn out process. So all these things together really just make self-storage a very attractive industry to invest in. Here's just a look at how self-storage has performed over the last many recessions. So the yellow line shows real GDP growth, and you can see that there was a huge dip in 2008 pandemic. And this whole time, if you look at this white line, self-storage occupancy has remained relatively stable. So that goes to show that self-storage is a non-correlated asset class compared to the stock market, for example, and it makes it one of the great asset classes to invest in if you're looking for that diversification. And here's another slide demonstrating why is there self-storage demand. So sometimes people say it's because people have a lot of extra stuff that they want to store, but when we're looking at self-storage, really the demand drivers are due to changes in life events. So when people can combine households, or when there's a relocation needed, or when there's a death in the family, when people move from one place to another. These are the reasons why people get self-storage facilities, and that's really what drives our occupancy at our properties. Okay, so what is the growth fund? So the growth fund is going to be a total of 4 to 5 assets that are opportunistic in nature, meaning they are we're looking to either expand an existing facility, or we're looking to do a ground up development entirely. And again, this really plays to Spartan's strengths. There are currently 3 properties that are already in the growth fund, which makes this a fantastic time to invest in the growth fund. We already know 3 out of the 4 or 5 assets that are going to be in this fund. And there's a ton of work that's already happened over the last year plus that everybody who enters Invest Now is going to benefit from. There's built-in value. So what are the 3 that we already have going for us? Well, we've got Bellevue, Florida. This is a ground up development. It's a 75,000 square foot ground up development. And we'll be going over each of these in detail. But for now, let's just go do a brief overview. The next facility is in Pea Ridge, Arkansas. Pea Ridge, Arkansas is near the new Walmart headquarters. And there's 2 other very, very large companies that are near there. So there's a ton of employment opportunities nearby, and people are coming to the area. There's very strong population growth there, 10x the national average of population growth. So this is an existing facility, and it's a really nice facility. We're going to be adding on to it. So there's a 27,000 square foot expansion that's part of the growth fund. And this has already been permitted. Construction is actually already underway. And it's a fantastic location. Our third asset that's already in this portfolio is the Kingsland, Georgia facility. This is also an expansion. So it's a 20,000 square foot expansion in the Kingsland, Georgia area. There's also a bonus parcel here that we may or may not develop, but it's an opportunity for the fund. It's not budgeted and it's not been pro forma. So now with that, do you want to go over the Bellevue opportunity?
Yeah, and before we jump into that, I just wanted to take a moment to sort of zoom out and look at the portfolio as a whole. So to sort of explain, why are we, jumping into this deal now, and what is it? So this is Spartan's 2023 opportunistic fund, and we probably should have touched on this a little earlier, but now that we're here, as Suja mentioned, it's going to be 4 to 5 total assets within this basket, and it's a diversified basket. So all the investors that are in the growth fund, the investment opportunity that you're looking at here, you are equally diversified across all of the assets within the fund. The great thing about this is that 3 of the 4 to 5 have already been identified, purchased, and construction's underway. So Spartan opened this deal all the way back in January. Our due diligence on the project commenced in about February or March. Suja, I know you were involved in a little bit of that. Our advisory board, which consists of Mike Rhodes, who has 40 years in the storage industry, built and sold the largest tenant insurance company in the nation. Actually, Spartan uses some of his software. He's on our advisory board. He's been all over this project. But back then, only one of these projects was actually identified. Excuse me. The great thing about coming in now, while those previous investors, their preferred return, of course, has been accruing this whole time, we're coming in at this stage of the project where it's been significantly de-risked, because a lot of the development work and the pre-development work has already been done. We have visibility on the assets. So somebody who came into the project or the fund in January just really had no idea. There was a buy box, and it was saying, "Hey, this is our target criteria." And a lot of our due diligence revolved around, okay, what is your target criteria? What locations are you looking at? What assurances do we have that you're going to select, the most intelligent possible projects to go into this as possible? But now we're towards the end of the year. This project is going to close out prior to the end of the year. And we just have fantastic visibility over what has already been placed in the fund, and we're even more excited about it now. So with that, we'll kick off. I'm going to kick off Bellevue, and then Suja will come back to you for the other 2. The target returns just across the whole basket is roughly a 22% annualized return, a 2x equity multiple, 15.5% IRR over a 5-year hold. And of course, these are just projections. These are based on numbers that we consider to be quite conservative. We've dug into the underwriting, and we've looked at the sort of the underlying data that is driving these projections, and we feel that it's sufficiently conservative to be very comfortable projecting these. But of course, it's just these are just projections.
Oh,
as far as
sorry, Tate, I'll just go over.
Yeah, of course.
These development options. So one of the things that we love about development, a lot of times people talk about the risk of development, and there is a certain risk that comes with development. Now, as Tate mentioned, a lot of the risk has been managed at this point because we've already gone through the entitlement process. We've already gone through the purchase. Many of these expansions have already been, we already have the financing locked in. Construction's already begun. So let's just go through in general when your possible exits are with development. So let's say you buy a parcel of land. Your first opportunity exit is just to entitle and to sell the land. So entitle it, get the permits for the development at hand. So that's already been done, as Kate mentioned. The next, so that adds to the de-risk of this portfolio. And the next option to exit is at certificate of occupancy. So as soon as construction is finished, you can sell and let somebody else stabilize the property. So again, we already have certificates of occupancy on 2 of the projects. And so we're working on stabilization on that already. So that is another, that's another option to exit, and we're going to continue to build on that value. So the third option to exit is at stabilization. So all that's left to do is to construct these properties. We don't have to entitle or sell. A couple of them already have certificates of occupancy. So we just need to finish out the construction projects. And then we will reach stabilization. and sell at that point. And so that'll take about 5 years as we are projecting. It could be sooner, but we like to say that it'll be around 5 years. All right, and I think with that, we'll go for the Bellevue investment.
Thanks. So Bellevue, Florida, if you look at the map here where the pins are, if you were an investor with us, 2.5 years ago, you might remember that Ryan and I flew a Cessna 182 all around the Southeast for the Southeast portfolio. And we actually flew into Palatka, Ocala, and Hudson. So I've actually toured those facilities. So exciting to see, and those are all performing wonderfully. So it's exciting to see another location right there in this high growth market. So it's 4.6 acres for development. As you see there, this is actually an old photo. This project was purchased from a landscaper who bought the land, and then just decided that he didn't want to entitle and do any development. So Spartan bought it earlier this year. Believe it was for 1.6 million. The trees have actually already been scraped, and the project is fully entitled and ready to go. And they've actually been working on this for nearly a year now to get it zoned and entitled for self-storage. So those are already in hand. And if they're not pushing dirt, we'll have to ask Ryan when he jumps on. Because if they're not already pushing dirt now, then it should be as soon as next week that project is actually underway. It's a fantastic location. It has over 600 linear feet of visibility along the highway. So as you're driving by, you get about 12 to 14 seconds where you're staring right at the property. And the most important things in self-storage are really, it's a localized business. So of course the location, but really traffic count, visibility, and signage and access, easy access. So as you can see there, you're able to make a left turn from the road going north there, make a left turn across traffic and into the facility. You're not locked like you are on a freeway where you have to keep going. Very high traffic count, and it's just a fantastic location in a massively growing market. So we have full entitlement approval on this project. I was speaking with Ryan about it last week. We actually just did a podcast about the growth fund specifically and self-storage in general. Full entitlement approval. Spartan is going to put a high demand. It's in high demand in this market. So half climate and half non-climate controlled storage. So for the people that want the easy accessibility and convenience of a drive up unit, we'll have that. We'll also have climate controlled. And that's based on just, a myriad of research that they've done on the market. This is also in, speaking of it being a high growth market, a massive population growth in this area. 3,800 new homes are being built there very soon. That's a development that's underway right now. Or am I thinking about a different one? In any case, sorry. There we are. So 3,500 single family homes right there in the first phase of construction. An additional 300 square single family homes within 10 minutes, and then nearing completion, 19 minutes away, there's a 1 million square foot Dollar Tree distribution facility. So just a ton of growth in the area, not just in the immediate local area, but in this whole area overall, just from my personal experience a couple of years ago in it. This is the Villages. So it is right near the Villages. This was the fastest growing metro from 2010 to 2020. And yeah, this was what I was referencing, the 3,200 new homes in the Villages due to complete in mid-2024. And that's on top of 50,000 total residential units approved between now and from 2017. So in a 6-year period, 50,000 residential units being approved in this county, and an estimated 1.5 annualized population growth all the way through 2050. So this area boasts 6 times the national average growth rate over the next 5 years. So just a fantastic place to be putting new self-storage. And then as far as the data shows, when Spartan did an in-depth dive on what all the self-storage in the area is showing, the competitors are 95% occupied. So basically all the competitors are nearly full. So just a great place to put an additional facility. So let's talk about the lease up plan. So the Bellevue property is a ground up. So this is taking raw dirt, entitling it. And that's really the riskiest phase, right? Is the zoning and entitlement. And that's already been done. We have the entitlements in hand. And as mentioned, the construction is, if it hasn't already started, it will start in the next week or so. The plan here is that year one rents, we're actually going to price the units nearly 50% below the market. And that's just to get the tenants in the door and to offer sort of a concession, take concessions in the first year and get people in the door. Little known fact that self-storage tenants are some of the stickiest of any asset class. Self-storage tenants tend to stay nearly 48 months. It's 4 years. And that's just because as multifamily has an average tenancy of about 18 months. So once you get those customers in the door, planning to bump up the rents in year 2, year 3, and we're just going to do that nice and gently throughout the hold period, and then to where we're going to get to our stabilized rents all the way in year 4 of just slightly what the market is showing right now for a full stabilized lease up. And we've given ourselves a full 36-month lease up on this, 9 to 19 units per month. That's based on the season, which is exceptionally conservative. We've been seeing much faster lease ups. We'll mention the lease up rate on a different facility coming up here. But a 36-month lease up is an exceptionally long, so very conservative. And we've additionally factored in $1.1 million to cover lease up costs to make sure that we have enough to get us through that business plan. And then the great news is, hey, the break-even occupancy on this thing is only 62%. So as we lease it up, as we pass about that 62% occupancy rate, the facility is breaking even. The financial highlights on this one, this is just to sort of highlight the net operating income here of $943,935. So that is a stabilized facility, what the net operating income is scheduled to be. And if you compare that to the total cost for this specific project, which is about $10.1 million, that comes out to a 9.3 yield on cost. So if anybody here is familiar with cap rate, if we could buy a facility at a 9.3% cap rate that was as nice as this and as beautiful, Class A, brand new build, and that would be, everybody would be salivating at that deal, right? So extremely attractive yield on cost. In today's market, we could sell this at between a 3 and a 4% cap rate. So very, very strong there. We have conservatively projected a 5.8% exit cap rate on it. And it's projected to have a 1.67 debt service coverage ratio, which is, that's a nice cushion. So if you're familiar with the DSCR, banks want to see about a 1.25. So that says, hey, after everything's said and done, we want you to be able to pay your debt service and have about 25% of your profit remaining after you've paid all the debt. We're projecting on this out the gate to have a 1.67. So very comfortable number there.
Do you want to go over this first?
Sure. So in terms of how much equity is coming into or being allocated specifically to the Bellevue project, just shy of 3.8 million. The primary loan on this deal is 6.37 for total sources and uses. Total sources of 1.2. The acquisition got that slightly off earlier, 1.4 million for the land, and then of course the construction cost there. So that's just kind of
a question come in about what's driving growth in the Bellevue area.
What is driving growth in the Bellevue area? Well, I'm sure that Ryan can speak to that more when he jumps on. But if you look at sort of the Tampa, Orlando, I mean, Florida is just exploding. This has been the catalyst really being COVID, and it's just continued since. Businesses are moving out of New York and California, it's a red state, it's a growth state, and so we've seen sustained tailwinds there.
Okay, great. Well, Ryan actually just jumped on. Ryan Gibson from Spartan Investment Group is here with us now. Thanks for joining us. And I'm going to just review these two investments and then we'll let Ryan jump in. So the second investment that is in this portfolio already is in Pea Ridge, Arkansas. So we're going to be doing a 27,000 square foot expansion on this property. It's existing. You can see the buildings are already operational. And in this yellow square, there's currently RV parking. And we're going to be building in that space. You might think RV parking isn't that in high demand. Well, it is, but the amount of rent that you can get per square feet is much higher with self-storage, and with all of the demand in this area and all the people moving there, there's a huge unmet demand for self-storage. So we're taking advantage of that, and the RVs have actually already been cleared, the property has been graded, and construction is underway. So this is actually already a really nice facility. You can see it has a really nice lease-up room. It's just been re-asphalted and just a really beautiful facility already. So we're just going to be building on that, and it's a Class A facility. You can also see that there's additional parcels. So these two parcels that are in front are also part of what we own. We're not sure exactly what we're going to be doing with them yet. Nothing has been pro forma'd. So if we sell them or develop them, that's just going to be bonus for investors. So we call those bonus parcels. And as you can see, it's just a really nice facility. So we're excited to be a part of it. Let's see. Oops. Oh. No. Okay. So why do we love this particular deal? So Pea Ridge, Arkansas. Now you might be wondering, where is that? Well, it's 10 minutes away from the new Walmart headquarters. It's also near two really other very large companies. And so it's got 10x the national population growth. We've got a very favorable debt. So we've got a blended rate of 4.8% on this particular project, which is really excellent given that if you're going to get a commercial loan, in many instances today, it would be 8 or 9%. And we already know the track record. This facility is already performing extremely well. We have a lot of historical data on it. We know the property well. So we know what we're getting ourselves into. And as we mentioned, the investors who are coming in right now, there's a ton of risk has been already managed because the expansion is already underway. So again, here's a little bit more about the historical performance on this deal. And this is an explanation of how we got the 4.8 blended interest rate. So we've got a purchase loan for 3.5 million and a construction loan for 2.5 for that additional 27,000 square feet. And between the two, we've got a blended rate of 4.8%. There's a ton of demand for storage in Pea Ridge, Arkansas. As you can see, there's 97% occupancy, so a ton of demand for storage in this area. And it's only a 15-minute drive from the state-of-the-art brand new campus, which is driving a ton of population growth as well. And here's a picture of the expansion. So these are the 3 buildings right here that are going to be, that we're going to be on the bottom right here, that we're going to be building. And we're really able to build these based on what the market is demanding because we already know how this property is performing. We're able to build the kinds of units that are the most popular. And here's some more imagery of what we're expanding. And here's our sources and uses. So we're only leveraging 49% in order to do this expansion. We've got a $9.5 million purchase price. and we've got $71 per square foot of construction, which is quite low. And the reason we are able to do that is because the site's already been graded, and we know our costs pretty well. We've got a 46% break-even occupancy, which is very low and comfortable, and an amazing 11.1% yield on cost. So a really excellent opportunity. And we've budgeted a conservative 6.8% exit cap rate. So what that means is that when we're looking to sell the property, we're being quite conservative with what we think we're going to be able to get for it. Ryan, is there anything else you want to add on the P Ridge facility?
Yeah. Can you guys hear me okay?
Yeah.
Perfect.
Yeah, we got you.
You know, it's funny. I just logged into our construction camera, and to my surprise, actually, the buildings are already going up at P Ridge. So foundations are already poured, and the buildings are already out of the ground. And I just sent a picture in the chat off our construction camera today. That was taken about 3 hours ago. So
Thanks, Ryan.
yeah, pretty cool.
Awesome. I'm just going to go through a couple questions that are coming in as, and Ryan, if you could speak to someone's question. These facilities appear to be in locations that can be impacted by severe weather, like tornadoes or hurricanes or flooding. What considerations are made to hedge against that? Ryan, do you want to take that question?
Yeah, and so I think the question was just basically surrounding kind of like our insurance concerns, weather events, things like that. Is that the question? Okay.
Yes.
Yeah. So yeah, our underwriting policy is first of all done from an A-rated carrier. This is a self-storage insurance agency that does self-storage exclusively. So when we underwrite our insurance, we're underwritten for wind, flood, and any environmental considerations that we'd have in the markets that we're in. And most importantly, it's from an A-rated carrier. So as far as having any concerns for that, it's been underwritten and planned for in the insurance. Did that answer the question?
Yeah.
Okay.
We had someone.
And by the way, Ryan, you have had a tornado go through an RV park that you own. I might mention that, right?
Yeah. No, I mean, if it's happened, or if it can happen, it's already happened to us. So we've been really battle tested with what can happen with weather events. I mean, we've had tornadoes, we've had hurricanes, we've had I think it was Hurricane Ian. I think it was last year in Bonita Springs, Florida. We've had a lot of different things happen with different properties. I mean, we're an area, we're all over the country, so we deal with things like earthquake. Insurance is important in some places, to tropical. So we're pretty familiar with Florida and all the insurances that go along with that, with those requirements. So no concerns.
Okay. Someone asked a question about year one, year two, and exit numbers. And I know this is a development deal, so we don't have, will you speak to that, Ryan, about our kind of certainty or lack thereof on year one, year two, and exit?
Yeah, so year one and year two exit numbers, as far as how we determine what the sales price will be, is that probably what it's getting at?
Yeah, I think like how speaking to cash flow during the deal, as well as the cap rate and how we're choosing that.
Yeah. So yeah, good question. So we're actually we work pretty closely with the top 3 self-storage brokers. They do anywhere from $1 billion to $3 billion a year in annual transactions. So before we buy the land or even look at these deals, we actually go to the top CBRE and storage brokers, and we basically say, hey, what would the exit cap rate be on an asset like this in this kind of market? And we actually get kind of like a BOV, or broker of opinion of value, on what these assets would trade for in the cap rate. So we're getting feedback from the market, and then we're packing in some conservatism based on where the market is at currently, where we think that you can't really predict where asset values are going to go. So we just predict them getting worse. And that's how we're driven to our cap rate analysis for the exit. As far as cash flow goes, I don't know what you've spoken to as far as cash flow projections, but this isn't really a cash flow investment. It's for investors seeking upside potential. So I think if you are anchored to, looking for cash flow, I'm sure Tate and Sujata have like a really good opportunity elsewhere for that.
Mm-hmm.
But when it comes to cash flow, it's going to be difficult to predict when the cash flow will come, and I wouldn't be banking on. I would be a little bit apprehensive to say, in year 2, month 12 or month 10, you're going to get cash flow. So that, because this is ground up development, then you have to lease up the property, so it could be a while for cash flow. I know that's not really direct, but I just wouldn't be doing this fund if it was for cash flow purposes.
Yeah, and I don't think we've mentioned anything
No,
about cash flow
yeah.
so far. There has been some cash flow, Ryan, right, throughout this year that was sort of unexpected, but yeah, this is not definitely not marketed as a cash flow deal.
Now, having said that, I will say that P Ridge, our expansion, I mean, the buildings are out of the ground. We're going to be done with the expansion by the end of the year, call it end of January to be conservative. Once those units lease up, we've already got a full facility already there. We got to lease up the additional units, and like we'll be to cash flow on that property, right? But then Bellevue, on the other hand, is ground up. We broke ground on that already. Construction crews are out there pushing dirt and building the property. We expect that to deliver in September of next year, but then that could take a year or two to lease up. So that is going to cash flow at that point in time. And then Kingsland is already 35% occupied now. I just checked, it's leasing up crazy, right? So I think there might be some surprise cash flow, but I wouldn't be walking into this investment thinking that it's going to cash flow by a certain month. I think that would be a little bit misleading.
Yeah, for sure.
Yeah.
Thank you for that. Sorry, I was just looking for the slide that the person was asking me about, but I'm not exactly sure. We hadn't spoken to cash flow, but I think they were just referring to how the rents were going to be slightly increased every year.
Oh yeah. Yeah. So we usually discount our asking rates by a lot. So we'll like look at what the market's charging. And we usually discount it by at least 30% in the first year. Because we want to get our customers in, get them, because our customers are very sticky. Once they move in at that really good rate, then we'll slowly increase the rates as we increase occupancy.
Yeah. Okay, well, let's go over this last investment. I'll kick it off, and then we can wrap up with questions and take anything else that anyone wants to talk about. So Kingsland, Georgia, this is the third asset that we already know is in the portfolio. It's already been purchased, and it's entitled. So again, another Class A facility. This is, we actually purchased this from the general contractor. So we purchased it brand new, and we've been leasing, Ryan and team have been leasing it up since mid-August. It's been extremely impressive in terms of lease up. So it's 25% leased in just less than 60 days, which is a really great pace, especially for fall, which is the slow release up season. The main lease up seasons for storage is spring and summer. We've got bonus land in this property as well. So this red outline is bonus parcel. So we don't know what we're going to do with it. We might not do anything. There's nothing planned for it. But if we do sell it or develop it, then that's going to be a bonus for investors. And yes, we've had a fast lease up rate. So you can see right here just a picture of the area that we're going to be expanding, this 20,000 square foot expansion. And again, this is another great location. It's in the Jacksonville MSA, which is a location that's growing extremely quickly. It has also got excellent visibility, just like the Bellevue property. So easy to see, easy to access, which is very attractive for self-storage customers. Additional land.
Just to be clear here, I want to make sure that we make it clear that this property was purchased at certificate of occupancy. So there was a developer that built this, had no plan of leasing it up, sold it to Spartan as a CFO deal. And Spartan has been taking it through lease up while simultaneously doing the 20,000 foot expansion.
Yeah, exactly. Thanks for the clarification. And again, there's a tremendous demand for self-storage in this market. There's still 288,000 square feet of demand in this market. So we have no concerns about leasing it up. The current market occupancy is 91%, so pretty much full. And the location is just another excellent location, 3 times the national growth rate. There's a ton of housing going into this area, tremendous income growth at 2.76 annual income growth. That's really strong. There's a lot of great jobs in the area. And again, 288,000 square feet of unmet demand for storage. These little bubbles are other units that are coming up in this area. And so you can just see there's a ton of development in this area, which is really good news for self-storage because it is driven by population. It's a very favorable market demographics. This deal is also very low leverage at 52%. We've got a purchase price from the general contractor, like Tate said. So we purchased it, it was 0% occupied when it was purchased in mid-August for $4.55 million. We've budgeted $95 per square foot for construction. This is a little bit higher than the Pea Ridge facility, but there's just a ton of cushion built in there. So we think we could probably build it for $75 or $85 per square foot without a ton of cushion in there. And we have a 1-year lease-up assumption. So we've got an operational loss coverage at $320,000 during lease-up. And we have another really comfortable break-even occupancy of 58%. And another very attractive yield on cost for development at 8.9%. So as a whole, we're looking at 3 different properties that are low leverage, strong lease up, low break-even occupancy, entitled projects, and construction underway. So this is just a really excellent time to enter this development fund. And yeah, is there anything else you want to say on Kingsland, Ryan?
Yeah, just that I just checked the occupancy. It's at 35% now. So
Oof.
It's continuing to trend.
And that's since August. That's amazing.
Yeah. We'll have it at this rate, by the spring it'll be leased up.
Awesome. Yeah, that's fantastic. All right, so one quick question came in. Are preferred returns accrued? Yes, they certainly do accrue. So even though, this isn't really a cash flow deal, the preferred return of 8% will definitely be accruing. Kate, do you want to go over the deal room?
Yeah, this is just a snapshot of the deal room here. Just a lot of people ask, well, what are the next steps? Well, if you go to the email that you registered for this investment webinar from, you're going to have a link to the deal room there. Just log on to the investment portal, and that's where the investment takes place. Just click that Invest Now button. That takes you through the commitment flow. A question that comes up a lot is, do I have to be accredited? The answer is yes. If you have an accreditation letter and you already have that accreditation letter with us, it'll just ask you to self-certify. If you haven't gotten one yet, if you just go through the commitment flow, it allows you to get a letter right there in the commitment flow. So with that, we got the man himself here on the call. So I'd like to turn it over to you, Ryan, and just chat about the project. Maybe you could give us some high-level points while we give some people time to put follow-up questions in the chat. And then Suja, I don't actually have access for some reason to what people are typing. So if you could take us through the Q&A, that'd be great.
Yes, I will facilitate Q&A. We do have a couple questions coming in. So Ryan, an incredibly optimistic picture of this deal has been made. What could be the most likely thing that could derail or pose a challenge for the project?
Yeah, so that's a great point. I think there's 3 main risks whenever you build a development project. That of entitlement risk / permits. That is your first risk, because if you don't get permission to build what you want to build, it's kind of a worthless piece of land, right? The second risk is construction risk, where there could be overages and overruns and timelines go crazy in the construction phase. And then your last major risk in a development deal is your lease up. So when you think about what remains in risk in this project, in addition to anything that's outlined in the PPM, the major risk that remains in this fund is lease up. So once we build these units, will the self-storage customers come and rent our units? And that's kind of the main risk. I think that some of that risk has been mitigated already with the Kingsland facility is leasing up. and the fact that P Ridge is already a well-occupied property. That being said, we still have to build Bellevue and we still have to lease that up. So that is an outlying risk that's still in the deal. So I think these are positioned well with all entitlements and permits approved. But lease up is always an existential threat to the property, making sure you're getting your customers.
Ryan, can you speak to a question about incoming competition? So I know typically Spartan likes to build in tertiary markets where there's lower likelihood of newer buildings coming in. How do you see that playing out in these three?
Yeah, I would say that there's markets where it's easy to build, and that's great for getting your permits and entitlements, and then, but bad for competition potential. And then there's markets where it's harder to get your permits, and then you kind of create a moat around your competition. I would say that, I'll go project by project. It's very possible in Kingsland that another operator come in and build a property. That is always a threat. And in most markets, in any market really, because restrictions can always burn off. In that market though, we already have a pretty high head start, right? We already have a building built. We already have the investment leasing up. The other thing is we're actually potentially buying more properties in that region. So we're going to start having economies of scale efficiently. We're looking at 2 properties right now in St. Mary's. Which would make us a kind of a dominant player in that market, but not competing with each other. The properties are far enough away. So when you think about getting economies of scale, we get better efficiencies with advertising to more people and better economies with payroll. So it makes us a better operator. The P Ridge market does have the possibility for competition, but we are positioned as the nicest property in the market currently. So we would have a long runway before that would actually become a threat, potentially for another operator to come in and build. And then Bellevue, I would say, is probably unique. It's not that people couldn't build in that market, but we had to go through a special zoning approval to get that property built where it's at. And it's in a really nice location. I mean, the 28,500 cars a day that drive by it, the zoning that was required to make it happen. And then it's just unique positioning along the road where it takes 10 to 12 seconds to drive by it. It's a pretty rare layout for a storage property, which is great. But yeah, I would say, there's nothing stopping somebody from coming in and building in these markets. That is a risk that we have.
Okay. Another question about tax benefits, depreciation that's being passed on. I know this is the development deal and it's storage. So can you speak to how that might play out for investors, Ryan?
Yeah, so you can expect 20 to 30% of your investment amount to be depreciated over the course of this investment. The issue is it's not going to all land in 2023 because Bellevue, you're not going to get any depreciation on that ground up development until it's entered into service or until we start renting out units. So we do anticipate depreciation on that asset in 2024. So as we build and deliver expansions and build ground up properties and enter those new buildings into service, in that tax year that it falls into, you'll get depreciation. So there'll be kind of more rolling depreciation throughout the course of the investment.
Okay, perfect. And can you speak to additions to the fund besides the 3 that we've reviewed?
Yeah, so the fund does have the opportunity to refinance these assets and go buy additional properties. So there is an opportunity, if it makes sense, to add additional ground up developments or value add properties to the fund. Now, we are restricted after a certain period of time. We no longer can buy more properties. So it's not like we can just endlessly buy properties forever in this fund. This is considered a closed-ended investment, meaning that at some point we are restricted from buying. And I believe the restriction is 18 months and we're about 12 months through that. So at some point, this is going to be what we have, and that's what we buy, and that's what we can put into the fund.
Okay. And there's also a question about how you will decide whether to do anything with bonus parcels or not.
Yeah, we have a full-time development manager at Spartan now. He was actually used to work for Red Robins. He would build and entitle Red Robins for corporate. And so he actually looks at all of our parcels, all of our land that we have throughout our portfolio, and we're looking for the best ways to uniquely position and sell those parcels. So we look at for highest and best use. Maybe in P Ridge, it might make sense for Dollar General or for a kind of a gas station to go there. It might make sense for Kingsland. That would probably only be additional storage. Probably wouldn't be much else. I don't predict we would build additional storage in P Ridge, but maybe it could be more RV storage if we wanted to grade that and put that out there. So it really just comes down to what makes the best sense. In P Ridge, they're doing a lot of infrastructure projects. And so we're waiting them to do kind of perk those lots by running city sewer and city water to those sites. And that's going to make those parcels much more valuable. And we expect that to happen actually pretty soon.
Okay. All right, well, that takes care of all the questions. So thank you, everybody, so much. This is a really exciting deal. We're excited because we think that a lot of the development risks have been mitigated already. Of course, there's risk in every opportunity, but this provides diversification as well, since we have at least 3 properties in the portfolio. So please email, you know how to get to the deal room for either Tate or myself. Before we wrap up, Tate, do you have anything else you want to say?
No, just that, Ryan and I have been working together, for a long time. And, we've got a very long track record of success with Spartan. As mentioned earlier in the webinar, it's been 2 years since we've offered a storage project. We've sort of watched a number of opportunities go by in that time that have also been very successful with you, Ryan, as we've been, maybe not distracted, but busy with all sorts of other stuff that we have been doing. So very excited. This particular basket of deals piqued my interest more than anything I've seen come across my desk in the storage realm anytime in the recent past. So I'm really excited about this one, and happy that we can round out 2023 with a storage deal with you.
Yeah, looking forward to it.
Awesome. Well, if you have any other questions, please reach out to Tate or myself, and we will see you guys soon. Thank you.
Thanks, everyone. Take care.